Hi, this is Keith Schneider, CEO of MarketGauge.com. This is February 21st, 2016 edition of Market Outlook. So we had a short week, but a pretty powerful rally, um, although on light volume. Let's get into some of the details. Gold, certainly, and gold miners still very much in play and interesting. We're going to cover that. Okay, so first thing, let's take a look at the spider chart. This is the S&P 500. As you can see, we actually took out or pretty closely matched the lows set back in mid-January, and certainly exceeded the lows back in August on an intraday basis. But on three occasions, we've certainly rejected the 180 or so or 181 level. We had a smart rally off the lows. So you're talking about just about a 10-point rally, 5-6% off the lows for the week, almost 3% in SPYs alone. One thing to note is, look at this. On the sell-off here, we did have pretty close, pretty nice volume on the day, but not nearly the blow-off that we had, as you can see, back in August of 2015, or even the early part of January. So the climactic sell-off, I don't see. Additionally, you can see we've had pretty light volume, and we'll get into accumulation versus distribution. Now, what's happening here, we got the rally. We thought we can get certainly up to that 195 level where you have the declining 50-day moving average, but we sort of paused. So we got up Thursday and Friday, pause days, down marginally on Friday, almost flat, somewhat down on Thursday. So we've got some compression here. How we play out against this 3-day pattern is going to be really interesting. And I would say that could be a harbinger for quite a while. Let's take a look at the Qs. Similar story. The really flash crash, in essence, that we had in August wasn't even broached on this down move here. But as you can see, we're a bit further from the declining 50-day moving average. That's moving pretty steep. And we do have some interesting overhead resistance. And again, same situation, not really interesting volume, and really not enough on the lows to say we truly had a climactic sell-off as well. Let's take a look at the calendar range on the spiders. As you can see, last week we reclaimed the 6-month calendar range low. So that sort of put us in neutral territory. And more importantly, on Friday, we managed to close above the January calendar range low as well. So we're definitely improved quite a bit, regained the lows in each of the time frames, both the monthly and the 6-month, and we're sitting right on it. So that is definitely a key point. And another thing to keep note of is, of course, the February calendar range high comes in right around 195. So everything is converging around the moving averages, that resistance level, and that calendar range, which comes in just above that 195 level. Taking a look at market breadth, we were extremely oversold. You can see the cyan line here is the number of stocks above the 10-day moving average. We did hit above the pretty high-end reading, and as you can see, we paused. Now, it's interesting because if we get much above that pretty extreme reading, in those type of situations, it's often positive and shows that there's more room to move. Obviously, that happened back in October as well. So when we bounced off that August and had the double, the test there in August and October of those lows, when we got overbought, it got extremely overbought. well above the plus 425 number of the 500 S&P stocks, and you had another remainder of the rally, although ultimately it ran out of steam. That is one thing to be concerned about here in terms of can we get further power through. So this next couple of days worth of action is really going to tell us a lot about how this thing is going to play out. And again, long-term momentum definitely in trouble. Now this week we're going to do something a little bit different. We are going to go to the website of Market Gauge and go through some of the market internals. So first thing is if you go to resources, you can see little big view, and we have a number of charts in little big view. So let's take a look. We mentioned about accumulation and distribution. As you can see, we're down pretty smartly on the year, just over 9% in Nasdaq and around 6% for the Dow and the S&P. But more importantly, what we have here on the website, and this gets updated on a daily basis, so you can use this and really help your timing of your trades and asset allocation as well here. But as you can see, we only had one accumulation day over the last couple of weeks with a lot more distribution days. So what is that telling us? That the market basically is still under distribution, and there hasn't been any huge accumulation days which could almost offset the number of distribution days over here, but that is clearly not the case. So a negative here on volume. Let's take a look at some of the market internals. And again, this is updated daily. Looking at New York Stock Exchange, advanced declines, and up-down volume. Interesting, you can see we're starting to reach levels that are overbought, certainly in up-down volume. Problem is, not much participation. This lower chart here, advanced declines, really not getting going. So meager distribution across the number of issues up versus down, right? It looks like we're at the middle part of the range. So even though we got some really good up-down volume ratio numbers, not much participation in the issues. That is a further sign of iffiness here in terms of just how far we can carry. The McClellan oscillator, which looks at advanced declines as well, but over a longer term basis. This is 10 days. The McClellan is really averaged out between about the last 40 days. So this is a bit more of a longer term or intermediate term indicator. And clearly you can see we got to potentially an overbought region. It's exactly where it found resistance, and the market sold off in beginning of February, had a nice 5% or so drop, and we're at the same levels and hooked down. Now, we haven't hooked down completely through what we consider the demarcation here. So again, in terms of that dead cat bounce, and it's still flying, the ball is still, or the cat is still up in the air, because we're sitting right here on the level where we would want to see it break, but it hasn't done it yet. So I would look at this as a neutral until it confirms one way or another. Again, if we can get really a lot more overbought, hit the 250 level, and again, you can come back to the website and monitor this because we update it every day. You can certainly see that when we get more overbought, it often keeps on going further. But if we hit resistance and start turning down, it also becomes a perfect indication that the market's overbought. So net, more on the negative side here on the market internals regarding the S&P 500. Okay, let's take a look at the next chart. Now this is the Nasdaq Composite Index. As you can see, we're at overbought levels on up-down volume. Advances, declines, definitely having issues here as well. So very, very similar story. The McClellan oscillator used on the composite, same sort of scenario, except we hit, we didn't quite hit the upper region. So Nasdaq, and as you can see against the 4600 level, we're quite a distance from it, which is a different picture than the S&P, which is a bit closer. So Nasdaq definitely weaker on a relative basis. Okay, let's go to our next chart here. This is new highs, new lows. This is an interesting chart. Obviously, a strong market is increasing, right? It's new high, new low ratio. What we like to see it is coming from oversold condition. And again, these indicators work great at extremes, and then when it starts easing. So right now, the demarcation is the 30% level when we've been under it, and now we turn back over it. We want to see it back over the 30%. And so this is another point to monitor. Right now, new highs, new lows, still in trouble, right? We got really oversold, had a bit of a rally, but it failed again, back under that 30%. We really want to see it back over there. Right now it's still under pressure. You can see the actual number of issues here on the bottom, and you can see very, very weak showing here, and we would really like to see this turn up above that 30% level, and we're not quite there. So this indicator is a negative. Let's take a look at the next chart. Now, this is another interesting tell. Nasdaq 100, excuse me, this is the Nasdaq 100 looking at new high, new low ratio as well. And guess what? We are really weak, right? So remember we were talking about advances, declines, and this is another way to look at the strength of advancing issues and just how strong those advancing issues are. It's like another level of detail further. The QQQs are really weak. So the new high, new low ratio, not really doing all that well for the NASDAQ. And if you drill down on the NASDAQ 100, even worse on new highs versus new lows. So market internals are definitely indicating a bunch of weakness, although, right, there are a couple bright signs potentially really regarding the S&P 500. So we've got to watch those as well. So you put the whole picture together, and I would be looking and checking on this website on a daily basis just to see how things are playing out. Okay, next chart. Let's take a look at sentiment. Okay, this is the VIX, right? Volatility ratio. As you can see, we're sitting above the 200-day moving average, and basically sort of in the mid part of the range. So volatility not telling us very much, except for one thing really to note here, is that even as we made new lows, volatility did not just really matched and did not really show excess panic. So even though we're trading lower than the lows made in August and October or late September, right? We're trading lower here, but look, the volatility did not. So now that's more of a positive sign, a little less panic. But I could tell you right now that if we get above this 28 or 30 level here, that is not going to bode well, and that would really be a confirming indicator that the markets are going to fall quite a bit further. So at the moment, right, this short-term little compression here is something to watch. All right, we have another one last chart to cover, and that is the ratio of short-term versus long-term volatility. I had pointed out that we were moderately, and again, take a look at the difference between what happened here in August versus what's happened here in 2016. So we haven't really flushed out in terms of sentiment, panic levels. We did get to oversold levels and we're bouncing. So this is definitely more of a positive. We're coming off these lows and it's moving off quite nicely. And that ratio is definitely showing signs of strength. So sentiment here, human emotion readings here, definitely improving quite a bit. All right, so that pretty much takes into account all of our market internal indicators and sentiment. One last thing I'm going to cover is, let's go back to gold. Because we have an interesting pattern in gold. On the daily chart, we're just going to focus on this. You can see we're definitely in play. We're in what's called an accumulation phase, right? On this huge move up, we did have sort of potential huge blow-off type volume. The market did correct, but look, considering the size of the move in the underlying equities and that gold was definitely moved to as an alternative place to put your money, and hence this huge move up, guess what? It barely sold off on a relative basis. So gold still strong, and look what we have here. We've got an inside day. So we've got an interesting trading pattern. Also, you can almost look at this as a pennant or a version of the flag pattern. So inside day plus the pennant, if this thing moves out to the upside, you're definitely trading in alignment with the bigger term trend and momentum. So let's keep an eye on that. Gold still in play, looking overall pretty positive, along with this type of pennant and inside day formation. If we can get above here, you definitely want to be a follower, and stay with it. But this is also lending more to a negative case for equities. But of course, you're going to want to see where this just moves and breaks out from. Now, on the flip side, if we break down to the negative on the pennant, we've got support somewhere around the 200-day moving average. And again, this 50 is moving up pretty quick. So you might find some support there, depending just how hard or fast this thing falls as well. That's it. Hope this helps. See you next week. And don't forget, especially for the new Trading Essentials people, we just rolled out this new course using the little big view on the website. Really can help you with the big picture. So don't forget to use that as well. Thanks, and bye for now.